Good morning, Happy New Year. And today is the 6th of January, 2024. Where did 2023 go? Well, we've had an interesting start to the year. We gave up a little bit of the irrational exuberance we had throughout November and December. So what do you think, Andy? Anything to be worried about, or are we just basically ranging about?
Yeah, I think you got it right. At the end of this year, and, as is typical, we usually start with what's happening on the front end of the yield curve. As of this year, as of the end of the year, the central bank expectations for rate cuts had gotten to a point where it had really gotten fairly extreme, with 165 basis points of cuts expected in 2024 and 230 basis points of cuts in the next 2 years. And equity markets do what they do often at the end of the year. They had gotten a bid up. And so it seems like we've, for no particular reason, given all that back, some of that back. And now we're resting at levels that are, more consistent with what's going on in the real economy.
Absolutely. No, I mean, what did we have this week? We had a holiday shortened week. It felt pretty light. We had NFP, which is now a secondary consideration to inflation, as Waller has been saying to us, because they're really targeting real interest rates. And the economy is just chugging along without any problems. The employment situation is particularly good. The real data from the economy is steady. We are getting a GDP between 2.5% and 3% real, which is all wonderful stuff. And now what we have to concentrate on is inflation going to keep on coming down at the pace that it has been coming down over the past 6 to 9 months, and therefore enable the Fed to produce the cuts that the market is expecting, or do we have to push those back? And I guess we find that out this week with CPI.
Yeah, I mean, I think that's what we have seen, and now what to look for next week. As you mentioned, the CPI is probably the most important data because, as we've seen, the economic data, the sort of real and survey data around non-inflation topics, in particular jobs, has been less impactful. And we're now at a point where this idea of real Fed funds rates and what the path of maintaining restrictive policy while reducing nominal Fed funds rates, we're now at the point where that has to be validated by data.
Absolutely.
And the way that gets validated by data is basically since, I would say it's been about 14 months when we had the first negative surprise, falling CPI, which occurred in the October report, reported in November 2022. Inflation has been a one-way move, just continued improvement in, or disinflation, improvement in the inflation outlook, to a point where it's now resting at target for many different rolling averages. And so that path validates the real interest rate path that the Fed has described in depth and suggests cuts in 2024. The question now will be, does the path continue, which to me isn't news, or does the path finally say, it's been 14 months of disinflation. We're going to get a surprise with a hotter number. And I think those are the outcomes, either on the path or, hey, well, maybe we've been on this path a little too long. And so the CPI will provide us with the next data point on that topic. And pretty much, I would expect to continue to stay on the path.
Yeah, I would agree with that. I think all that's happened this week is that the market has been ranging between the level that it broke when the FOMC came out in early December and the irrational highs that we made subsequently. But now we are at a very important inflection point, which will be as CPI comes out. Nothing much is going to happen in the first 3 days of the week, and everything is going to happen in an accelerated form from Thursday into Friday when we also have PPI. We mustn't forget that we have threes, tens, and 30s, approximately 110 billion worth of issuance. So the market is just going to digest those before CPI and PPI and then make its move. And really, there's very little that we can say that's clever about our portfolio at the moment or make any changes before we see what the CPI figures are. I agree that the danger would be if CPI is hotter than expectations, because that would change the narrative and really push back quite a long way the expectations of cuts. Probably, some houses have it in March, but most of them have in June. Certainly, any cut before June will be off the table, and then probably less cuts will be forecast as well from June out to December. And that will have quite a big impact on the short end of the bond market. And therefore, that would reprice equities as well, especially something like NQ or the QQQs, which have been suffering quite badly this week. 3% is not a small move, but really nothing for us to do before we see those numbers, is there?
Yeah, because the most likely outcome is no news.
Yeah. And on no news, what do you think? I personally think that the market keeps on pushing because that's what markets do.
Yeah,
But it's going to be limited, I feel.
yeah. I mean, I think we saw the extreme of the push. Without some serious real economic weakness, a big turn down in GDP, negative non-farm payrolls, something that the real economy, not the inflation bit. I get the inflation bit allows them to cut, but to cut to ease in a way that says things are getting really bad, you need to see some of that, negative GDP, GDP below target instead of well above. And the job report's starting to, show jobless claims in the, 3, 4, 500,000 level instead of, making a new low on the most recent jobless claim. So yeah, I think we saw the extreme without those other factors. And now the question is, what's the other side of the valley? The SEP has 75 basis points of cuts in for 2024 and about 50 for 2025. So that's 125. I can't imagine the market's forward looking. The market tends to push the Fed to cut, just as it pushed it to hike in 2021 and 2022. And so I would expect the Fed will be pushed by the market. I don't know, call it 125 basis points of cuts priced in for 2024 as the other side of the valley. And so here we are in the middle of the range at 140 basis points of cuts priced in, and with 15 basis points of sell off in twos and sell off in the front end, and maybe 20 basis points of rally. But the rally is going to need some cold data. But I think that's where we're at. And so that to me means that the market at this level is data dependent.
Absolutely. I think we are more data dependent than ever. And CPI is going to give us the next, 3-4% in equities and 3-4-5% in bonds. And all we can do is react to it like everyone else.
So let's extend that out the curve now. We saw a back up in rates to above 4% after 10s and 30s were, solidly below 4%. What do you think of the bond market at this stage?
It's tough to tell. CPI will definitely decide. I think the long end has far less to rally than the front end because that's where they will push if the numbers are low. But again, if the numbers are high and hot, as I said, they will push out cuts and they will reduce the quantity of cuts. We are on the cusp of, pretty big moves in both equities and bonds, but I really would not bet too much on either outcome. I think you are right that the most likely outcome for CPI is a neutral number as expected. And that actually gives, the bulls some room to run with the ball, especially at the short end. I think the long end is ranging in a 25 basis point range, and that is why I'm not hugely bullish on equities as a result.
Right. Yeah. And so let's play that forward and say we get the the inline number. Bonds, limited upside, that provides stocks with limited upside because for 6 months now, bonds and stocks have moved lockstep. Only bond price rally, and stock price rally have been almost perfectly correlated. So you didn't matter which you traded, bonds or stocks, long-term bonds or stocks, they moved in the same direction. Then we have this idiosyncratic period of time, earnings season, that starts with the banks on Friday, and bank stocks have been on fire, and I would expect earnings to be strong. And then we have earnings period for, running for 3 weeks. And at the end of that, we have the Fed and the QRA. And so the question that I'm trying to wrestle with is, is some sort of recovery of animal spirits that can take equities higher than the bond market would otherwise let them? Meaning, we get that inline number, there's not much upside in bonds, but can equities deliver some upside because of sentiment around earnings, expectations of solid earnings? That's what I'm wrestling with. I'm not sure what the answer is right now, and we don't have enough information, and we'll see the bank earnings on Friday. But that's what I'm wrestling with at this stage. Can we get a rally into the end of the month?
Yeah, I don't know the answer to that one either. I think that people will want to make the market do better, but I don't think the market can. I think there will be pushback from, people will sell into it. But that is something for another episode. And let's see CPI first, and let's send you an email as soon as we've seen it. And if we think that any changes need to be made to the portfolio, we will do so immediately.
Sounds great. See you next week, Nick.
See you next week. Bye-bye. So we haven't changed anything. This is still the allocations that we have. We are slightly more, I wouldn't call it bearish, but we doubt that equities have very much upside. The problem is that we don't know what CPI is going to be, so we're not going to be selling calls. But if I was running a different kind of portfolio where I was able to do it, I would sell calls out to Wednesday evening, Wednesday's close, against the positions I have. Here we don't really have enough in the portfolio to justify it, and you don't really get too much in terms of premium, so there's not really much point in doing it. I'm just saying, for people who have higher equity exposure, the likelihood of the market rallying the first few days of the week is actually very slight, because we have bond auctions which are going to limit the upside in equities as well, and therefore selling calls to Wednesday is not a bad idea if that's what you need to do, and you can do it in both bonds and equities. The likelihood of them being higher by the close of Wednesday is very slight. In any case, everything is updated. The broker statements are updated, even the monthly statement for December, and everything is here to the penny. Orders, as I've said, absolutely nothing firm. We will send you an email after the CPI, which comes out at 8:30 Eastern Standard Time, should we need to do any changes to the composition of the portfolio. I expect this number, if it's out of line, to be very significant, if it's out of line. If it's not out of line, we will still send you an email because I think that the market will then push, and I want you to be informed as to the levels that we think are going to be reached, because there you probably want to lighten up in equities and in bonds. Thank you very much indeed, and speak to you next Saturday.